Well, good evening, ladies and gentlemen, our guests in the Northern Hemisphere, and good morning to my friends and colleagues down here in the great lands down under. We've got a good lot of you here, including Alan, my friend from Brisbane, who suggested when I was living in New Zealand that I should come to this particular part of the world. He suggested Mudgee Bar. We had a few months there, Alan. I've then bought a house in Talai, and very nice, just next to Mudgee Bar, and the part I'm in is definitely where the officers live. So thanks for that. Nice to see you here, guys. All of our friends I know. There's FXFX. Ben, I'd like... Oh, Akshay's here. Akshay, I haven't seen you for a long time. Let me know what you're doing, mate. Akshay is a Daniel Code guy who was a junior broker at big brokerage in India, and he's gone on to be a prime trader for one of the big Indian banks. So he's done terribly well. Darryl, hello, mate. David. I'd like to say hello to all of you individually, but I'm afraid I can't. Gary and Greg, all of you, but Harry Lucas, God, strike me. My friend from the past, Harry's a eminent, and I do mean eminent, psychologist in Tasmania. He's a wonderful guy. He's a little bit older than me, but he's a little bit wilder, and last time I saw him he was still driving a very fancy E-type Jaguar. He's certainly young at heart, and he's a well-known teacher, coach, you might say, of traders with the psychology of trading, which is very important. So lovely to see you all here. Jamie Waters, crikey, we've got some good old friends. You haven't seen you lot for a while. Jerry Winter, our broker's here with us. John Egan, my friend, I haven't heard from you for ages. Let me know what's happening. Lots and lots of nice people here. There's Mark. And Marilyn, one of our newer members, Marilyn Boyd. Welcome, Marilyn. Really glad to see you getting started in your trading, and I'll be talking about the options for you very soon. Michael was down in the east of mate of mine, American, who's left America. He's forsaken his U.S. citizenship and lives in Panama. I think he's a hell of a wild guy, and he came down to the tutorial at Waiheke Island. We had a great time. Oh, Lord. Look at all my lovely friends here. Neil. Lockie, good to see you. Peter, all of them here, and Pierre up in Canada. Hello, my friend. And goodness me, Preco, we've got a lot of Sam, River Sam. Scott Sage is here, of course. Steve Leanhart, my American friend from lives in the Philippines, and Toddy. Nice to see you all. Tony Di Domenico as well. Look, I've got to stop saying hello to you all because time's running past. I don't know how you folks feel about a Friday evening webinar, but I can tell you it's great for me because it's Saturday morning down here at the Gold Coast on Queensland's beautiful resort area, the Gold Coast of Queensland. Best beaches in the world. Sun's hot, beer's cold, surf's just looking fantastic. Pacific Ocean's beautiful clear day today. So I'm very glad you could be with me. Let's tell you what we're going to talk about today. I want to have a look at some of the major trends that we've seen in Q1, and of course some of these trends have been going on, for 12, 13, 14 years. And much of that is centered around the demand for commodities and metals by China and to a lesser extent India. And you just can't underestimate what this additional buying power has been doing to commodities. So and what's likely to happen going forward. So we're going to review some of those really, really big trends, and then I'm going to tell you what I think is going to happen in the next quarter. But either way, right or wrong, I can tell you it's going to be a great trader's market. Some of this, excuse me, hype and comment about China has been going on for years and years, and everyone's a panic merchant. Excuse me, but the reality is the impetus is so massive it will continue to go on. we're going to see elevated commodity markets, and equities still have a way to go to finalize Newton's laws, which they are bound by to a certain extent, not as much as they're bound by the Daniel Code, but they all work together. So I've got a lot to go through with you today. And then in the second half of the show, I'm going to talk to you about FractZen. We have the final figures now in for the first quarter, January, February, March of 2014, for which we're greatly indebted to Sage, who keeps the charts and does the scoring of all of FractZen for us on a totally independent basis, and of course her husband Mustang, who many of you know. He's a chartered accountant, and he puts together the spreadsheets for us and pretty well audits the results. Now, I'll talk to you more about when I get there, but what I can say is it's incredibly exciting. 3 months does not actually tell us any more than what happened in the 3 months, but interestingly, with these FractZen signals, they across the 9 Forex and 11 futures markets that we cover, they do create about 70 to 75 signals a week. So when we look at 12, 13 weeks of data, we're probably talking about 800, something around that signals, which if you were looking at this sort of scoring on a normal daily chart on one market, for example, that might be 5 years worth of back testing to get that sort of data. So I'm not declaring mission accomplished yet, but the last guy who did that got his ass kicked. Ass, I should say, for the benefit of my American friends. But I am getting more and more excited about this thing because the way it's been going is quite extraordinary, and we'll come to that later. But let's just move on now and have a bit of a look at what's been happening over this quarter now. I'm a bit of a China follower simply for the reason that Australia's total livelihood pretty well is getting to be more and more dependent on China. The massive wealth that's been created in this country from mining and liquid gas exports, very much involved with China. The iron ore, the coal, and the liquefied gas is the other big exports from Australia, and a lot of that depends on China's health going forward. What I was not so aware of is their emphasis on food security. And if you just look at the points here, which have come from a Bloomberg article that I pulled up, you can see the massive amounts of money involved. They're quite spectacular. And the way that they're starting to focus on the next level of production. So we've known for some time that they've been buying farming land, and their aim is to get food security for their people. And a lot of that purchasing of farming land has been going on in New Zealand and Australia and Canada. But if you see the second point down here, they bought Smithfield Foods, the biggest hog producer in America. So they're now starting to vertically integrate their activities, and they're more than the buyer at the margin; they are the margin, and that's going to go on and on. There'll be little ups and downs. Things don't produce in a straight line forever. And the media, of course, who are focused on a 24-hour news cycle, get terribly excited about drops in the iron ore price. And, some of the bigger producers, bigger names anyway, the ones that get the publicity, probably don't want to see iron ore go down much below $90. But Vale, for example, which together with BHP, the biggest iron ore producers in the world, their cost of production is heading towards $18 a ton. So if there's any further reduction in the iron ore prices, which I suspect there will be because they're very elevated still, you're going to see the bigger companies more and more entrenched, and the rationalization of the smaller producers is going to continue because they tend to have much higher cost of production. So the chart I'm showing you now is copper. This is a 24-day chart. This is fairly long-term stuff. Just let me check that these pages are changing, so you're looking at what I'm looking at, and you are. This is a chart running from about 2002, so this is sort of the last 11 or 12 years, and this coincides with this massive growth, industrialization, and urbanization of China. And you can see that this market's lifted from sort of traditionally around $65 to $70, up went as high as $450, but it's been stable in that $350 range now since 2005. So this is really what this burgeoning growth of the middle class in China and the massive infrastructure development they're undertaking, this is what it's done to commodities, which is really quite extraordinary. If we look at here, so the next chart I'm showing you, which is soybeans, and you can now see it. You'll see exactly the same thing. The soybeans have run up from 425 in the turn of the decade, 2000, up to 1500 now, and they've been steady in that sort of 1200 to 1500 range now since 2008. And China, of course, is a massive importer of soybeans. They import about 40% of the world's soybean production, which is very important. And I could go through a range of other products that they produce, that they consume rather, including iron ore. And you'll see exactly the same sort of picture. This massive inflation is really what it is. It's demand really now exceeding supply, or at least catching up with available supply. And this is just massive price inflation, which the Fed will love, and economists will love, and producers will love. You and I, as consumers, ought to be horrified at all of this, because what the world really needs is a good bout of deflation to bring some sense and logic back to these prices, which are really quite extraordinary, and everybody must be feeling the cost of living, because these sort of massive long-term inflationary effects have very significant flow-through. Federal governments and economists hate the idea of deflation, and they have all sorts of theories about why it's bad. And of course, being economists, which in the past you've heard me refer to as witch doctors, the simple answer is they're wrong. What the world needs right now is a massive dose of deflation. And deflation is actually good, because prices come down, but so at the same time input costs come down as well. So the pure economic argument that deflation causes loss of production and loss of margin it is true at the time that change in trend starts to bite, but it doesn't last, because costs of production come down as well. And really the cost at the moment of almost everything in the world is just absolutely insane. So there's part of why. And what has matched the commodity boom? Well, this is gold you're looking at, and this is really the rationale and the logic of the great boom in gold. It's a shame the way gold's presented, in my view. It does sort of tend to mark most of the gold bugs as loonies. But we trade gold. We love trading gold. It's a wonderful trading market. But the real underlying logic of owning gold, you can see, is that it's about the only thing in the world that's kept up with the commodity inflation in terms of real purchasing parity. In fact, it's done better than that. It's gone from the sort of the 250 area at the turn of this decade up to where it is now, 1400. But it's been sticky around 1500 for 2 or 3 years. So that's 5 times, and that's actually better advanced than the commodity boom. Don't forget, of course, China and India are also very invested in the purchase of gold. So when you look at gold price and compare it to the commodity markets, the people who are invested in gold, long-term holders of gold, have a really very serious and sensible rational argument for doing so. Doesn't appeal to me personally because I'm a trader, and I like to trade it long and short. And if you follow the Daniel Code, you'll make a lot more money trading it than you will owning it without all of the risks of it. What else was hot in Q1? Well, and what else kept pace with the price inflation of commodities? Well, I've said here an Equities sort of, which is a sort of a childish slang expression, but I just want to bring to your attention the way equities have performed, particularly ever since the March 2009 lows. This is a 24-day chart, and you can see they've just been straight up. But no, they haven't kept pace with the inflation in commodities, because you've got to go back to 2000 to see that. And even though net effect you've sort of gone from 700s up to 1800s is pretty impressive. Those who've lived through the 2007 top and crash it at 2009 are never going to appreciate that argument. Small caps did best, not surprisingly. Bernanke had been on record saying that it's the US Fed's mission to boost small caps in particular. That's one of the markets that they use, and you can see that the value increment in the equity markets in small caps in particular has just been quite extraordinary. Excuse me, this is our S&P timing chart, which will just change for you. This is our 12-day chart, which has been the best of our timing charts. And what I wanted to just draw to your attention here in terms of what's likely to happen going forward is that I'll just get my highlighter over here, spotlight I think they call it. And you can see here back in 2011 we had the only serious pullback since this market bottom from the crash in early 2009. And the blue lines you see are Daniel Code trading channels, and we have two of those channels. The thicker line in the middle is the median. The line above it is one standard deviation. The next line above it is two standard deviations. And these are standard deviations using the Daniel Code ratios. If you don't know how to draw these Daniel Code trading channels, go and have a look at the Daniel Code website underneath the videos tag, and you'll see a webinar I did last year just dedicated to how to draw these trading channels and what they mean. And for longer term analysis, they are the best trading tool to just, simple stuff. It's not complicated like the Fourth Seal, which is the most amazing forecasting tool ever, but any of you can draw these channels, and you should be drawing them on your charts every day. And visually you can learn quite a lot about them. And the first thing is that way back in 2011 we saw this market have its first and only decent correction, and that low back in August, September 2011 went exactly down to the second Daniel Code trading channel. That's two standard deviations from the mean, and that's where you see the red dot on it at the moment. Now, our esteemed forerunner of all of this, who was Sir Isaac Newton, invented the laws of motion, declared that all actions have an equal and opposite reaction. And from there, I've observed that when markets get down to two standard deviations, or if they get up to two standard deviations, which gold did in its run up to the high, then the reaction will almost certainly go to the same point on the other side. So we've had a drop to two standard deviations way back there, and I've been waiting for this market to get up to this line up here. We've been bullish this market since the turn in 2009, which we forecast to the day, and the exact price, plus or minus 2 ticks. And we've consistently been bullish, and I'm still bullish because this would fulfill the laws of Newton's laws of motion. So we're looking for this market to get up to somewhere above 2,000, and time-wise, that's sort of around August, September, October of this year. Now, having said that, let me just draw your attention to what's happening here. This is one standard deviation, this blue line along here, the first one above the thicker line, and we've now had 1, 2, 3 closes above the first standard deviation on this is the 12-day chart. It is very, very hard for markets in any time frame to close above 1 standard deviation. And you'll see back here, we go all the way back. That's why these charts are so good. You can see things visually. There was a close, wasn't above the first standard deviation, was pretty close to it. And since then, you see this kisses the 1 standard deviation. This is straight down to the 2 standard deviation. Back to the mean. Along it goes. Up here, we got a close above 1 standard deviation, and we got a correction almost down to the mean. We've since had 3 12-day chart closes above 1 standard deviation, and that is next to impossible to maintain. So whilst we're still looking for higher targets in this market eventually, we're very, very overbought now, and those closes above 1 standard deviation pretty well forecast that we've got to have a correction. And the correction is going to seem like a big deal, but it isn't, because a minimum correction would bring you down here to the median, and a reasonable correction would bring you down here to 1 standard deviation below the mean, which is at about 1,700 and something. So that's more than 200 points away from where the market is now, and that's going to seem like a hell of a shock to the perma bears who don't understand anything about trading, but that's what markets do. So we're looking now for a better than average correction. We need this market to correct. It can't go on like that. It's sowing the seeds of its own destruction, and once we've had a correction, I'm sure that this trend is still intact, and we'll see this market continue. Now, don't be frightened of all of that. Just be very grateful that you trade futures, because the vast majority of the world, the great unwashed, they trade shares. And they're constantly in panic mode about those shares going down, and they will go down. And all that happens for the vast majority of those people, given that the rules on shorting shares are so rigid, is they lose money. For us, don't forget, we love markets when they're going down, because we make exactly the same money when markets are going down as we do when they're going up, and that's truly delightful. This next chart we're looking at is US T-bonds, which, as you can see, has been in the same Daniel Code trading channel since July 1999, and it has vacillated in that time between the upper 1 standard deviation and the lower 1 standard deviation. And just a few weeks ago in February, it hit the lower standard deviation. That'll be earlier than February. That's probably January. It hit that lower standard deviation and it bounced. Now, I don't see any reason why that trend won't continue. We'll continue to see vacillation between within the Daniel Code trading channel. The Fed has a new master who's in fact a mistress, but all of the US Fed, who are the people responsible for the way this market moves at any rate, I think are strongly committed to the fact that QE, which is really large corporate welfare, if you like, it brings enormous benefits to large corporates who participate in the US Fed bond buying schemes and repo. And of course, if you don't know already, all of that is paid for by the average citizen, particularly people with savings, who are impoverished by these ridiculously low interest rates that all federal banks or central banks at least have agreed is the norm that they want to see. Here's the CRB. This is the commodity index. This is the group of commodities. This is a 24-day chart, and it's just reinforcing what I've been showing you. That from 2000 up until 2011 or so, we've had this massive 250% increase across this group of commodities, which is pretty broad, and much higher increases in other commodities. And the retracement that we've had now has taken us down to the 50% retracement. That's that 506 darker red line. That's the 50% Daniel Code retracement. And the market's bounced from there. Now, we can tell a lot about trend from the depth of retracements. And a 50% retracement is just a normal retracement, and it keeps the uptrend in commodity prices intact. And as long as that 506 holds, look, it can go down to 472. It would still hold the trend up. As long as this upward trend continues on the longer term charts in commodities, we can look forward to further price appreciation in most of the commodities that we trade going forward in the next quarter. Those of you who've read some of my articles will know that for the last couple of years at least, I've been talking about natural gas and the huge difference there is between the American domestic price, which is sort of in that $4.50 range, and the international price, which is in the $15 to $16 range. That's what Australian exporters are getting. Historically, the reason for that is that America has not been a big producer of natural gas and has no completed export facilities. Americans, of course, will always find a way to maximize their economic potential, and there's something of the order of hundreds of applications in America now to build natural gas or liquefied gas export facilities. There's a fair lead time on doing it. It's a complicated bit of business to do, but expect to see lots of commentators banging the drum about exporting shale gas and other varieties of natural gas, which has not happened in America historically, and naturally they want to take advantage of the imbalance between the domestic prices in America and world prices. And while there's a lead time, I'm sure the market's got that very much in mind, and I think you can expect to see further strong increases in natural gas for the whole of the rest of this year going forward. It's a very, very big play indeed. This is our 6-day chart of equities. I've already shown you the 12-day one, but I just want to show you the 6-day one, which is the one we use more on a week-to-week basis. And it's doing exactly the same thing, even though it's a different time period. These things are all fractals, and once you draw the same sequences of Daniel Code trading channel, this one uses 1.593 as its standard deviation, as almost all of them do. You see the same thing, only you can see it's even more exaggerated. Here you've had 1, 2, 3, 4, 5, 6, maybe 9 or 10 closes above the one standard deviation on the upside, with just a 3-week pullback in between. And same comment, you look in the history of this whole thing, which we've been showing you since 1999, you can't find one close above the one standard deviation line until you get to this last period we've had here. So this equities markets here are, worse than overbought. They're crazy overbought, but that's not to say they can't go higher. We have on this chart exactly the same thing. Here's your correction in August, September 2011 down to 2 standard deviation. We still expect this chart to make the 2 standard deviation to the upside in due course, but right now it's very, very overbought, and we need a correction. And the bigger the correction we get, the more likely it is to attain that eventual target, because the world of trading is dominated by stock traders, who can't handle downside adjustments because they lose money on that, whereas we make money up or down because we trade futures that have the capacity for us to short them, that is, sell them, as well as buy them. The stock market will be in an absolute furore if this market corrects 200 points. And if it was to correct 200 points, that would be no more than a normal correction. So stick to reading the charts for reality, and only venture into the land of blogs and articles and expert commentary for your weekend entertainment. That's the best advice I can give you. Excuse me, FractZen. On the payroll announcement, courtesy of Sage. Those of you who don't know, we have a long-time Daniel Code member, Sister Sage. Many of you have met her. Any of you have been to tutorials have probably met her, who keeps these charts for us and does the scoring for us. And she does that in conjunction with her husband, Daryl, whose DC handle is Mustang. He's a chartered accountant, very, very smart guy, director of a large number of companies, and he checks all of these results. So you can have a high degree of faith that these results are correct. They are hypothetical in the case that they're not being matched by an actual trading account, but they are not hypothetical in the case that they are contemporaneously. They're prepared every day. Sage gets the signals and she finds the time the signals were transmitted to her in New Zealand, and she goes to the 1-minute chart to find the actual execution price, and she creates her records and gives us the chart from there. So this is pretty interesting, just to show you how the Russell coped with the dramas last night on the unexpectedly low payroll figure. Incidentally, of the 11 banks and economists polled, 9 of them expected an increase, and the only one that didn't was HSBC, which is really a Hong Kong Shanghai Banking Corporation, now based in England. Honkers and Shonkers, we used to call it. I've got an account with them. They're a very, very, very big bank, but they were the only one who thought the number was going to be low, which it was. But I want to show you here how FractZen coped with the drama that came through, well, today for you Americans, last night for us. I told you I'd show you the FractZen figures to the end of March, which Sage has compiled, and Mustang has now audited, at least gone through very carefully and put together for us. And they're quite extraordinary. And remember what I told you, we're now looking at, I guess we're talking about 14 weeks, are we? Let's see what the quarter is. It should be about 13 weeks. And we've been producing about 70 to 75 signals a week across the Forex and the future. So what you're looking at represents something not far under 1,000 FractZen signals in the first 3 months of 2014. So in terms of having any faith or comfort in performance figures, the bigger the sample you have, the better. You know, to find 1,000 signals on the S&P, for example, you'd have to include, I guess, 6 years, 7 years of data to get 1,000 signals. But with this FractZen, we have the benefit of, because it's a shorter-term trading signal, it's a system, it's created almost 1,000 signals in the first quarter. So what you're looking at is a summary of close to 1,000 signals, and you could say this is equivalent to a sort of 7 years of back testing or real-time testing. It's near real-time the way Sage and Mustang do it. And you can read all of that. The results are quite extraordinary. They again highlight what I've been telling you, that if you are going to pick and choose markets, then you're trying to pick winners and losers. That's very, very hard, because these FractZen signals are created in a proprietary form of volatility that I've invented. But it's not just volatility, as you know, it's a cumulative volatility that adds and subtracts, and it has nothing to do with the VIX, incidentally. But you can see here that futures, which is our summary on the top, we've got all of the individual markets there for you to see, has returned 104% on the initial margin, and 52% on the recommended account size. Now, for this model, Mustang is using twice the initial margin. And if you go down to the next patch below, you can see that Forex has done even better. Now, both of this Forex market has certainly slipped back notably in March from its earlier results in January and February, but that's to be expected. These results, they're going to be good months and bad months. So that's why we need to look at these over a reasonable period of time, but it's still quite extraordinary, and it's running at 170% for the first 3 months on a recommended account size that Mustang's used here of twice the initial margin. Now, I always have little discussions with brokers, Jerry in particular, where I argue about the stupidity of the margins that are set. And I'm coming to that in a moment. What I've done here, this is just another visual to show you how these markets have ranked once we've done the equalization of the profit. So you can see, you know that what we've done is we've taken the margin and calculated as a percentage of the DAX margin, which is our biggest margin, 24,000. And then we've adjusted them. So, I mean, you couldn't compare one sugar to one DAX. DAX has a margin of 24,000. Sugar has a margin of $550. So I've done the exercise of equalizing the margins. And when you look through here, I'll find our highlighter again, that spotlight, they call it. If you look through after we've equalized the margins here, you can go through this line here, which gives you the adjusted percentage on margin, and you can see that sugar, 544% on adjusted margin, is our best performing market in futures. Russell's number 2, then soybeans is number 3, silver's 4, number 5's got to be hidden somewhere, copper. And then we go down from there. DAX is 6, gold is 7, and they fall away. And we've got a couple of negatives in here. DX, the US dollar index, has done very poorly, and so has the S&P. And that's strange because if you look at the Russell, it's up there at number 2, and the S&P's down there at number 10. And they are markets that have a very, very high degree of correlation, and there will have to be a reason why one of them is doing so well and the other one is not doing well at all. And that will be the same reason that the DX, which is the US dollar index, has done so poorly. Now, I'm not going to tell you what that reason is now, but I will when we have a bit more data. I'm pretty sure I know what it is. And it'll be interesting to talk about that as this data unrolls over time. Down here is our Forex trading, which is quite stupendous. You can see what these profits are here, and that's trading the 9 markets that we are now covering. So we're covering 9 markets in Forex and 11 futures markets. Number 1 here is dollar CAD, Canadian US to the Canadian cross. Pairs Aussie US, it's number 2. GBP US number 3, and it goes all the way through. And the only market that hasn't done well here, that's losing money, is Euro USD. And you can put that in the same category as the US dollar index, DX, and the mini S&P, because it's underperforming for the same reason. I'm not going to tell you what that reason is yet. I don't have quite enough data to make that declaration, but I will, because I've been aware of that for quite a while. when we get some more data, we may need to change around a couple of those underperforming markets. And just to show the effect that those markets have, I will move us over here to the next page, and I've just called this page for you playing with numbers. I'm a fiend on spreadsheets because it's something I learned to do very early on, and I'm a numbers sort of a person, and I like to take numbers and play with them, move them around, see what the effects are. It's quite startling. One of the problems for all of you is how many of these markets can you trade, because of the requirement to put up margin means that very few of you can trade all of these markets. I've said to you on many occasions, trade as many as you can, because it's only by getting that diversification across a wide range of markets that you can be sure of capturing the volatility when it comes. To date, I have not been able to forecast future volatility, nor has anyone else, but until I can do that, then the only rational approach to trading is to trade as many markets as you can, so that you will capture the volatility that flows in and out of these markets periodically. So what I've done here is I've taken out in this first panel up here, let me go and get my highlight bar again, the spotlight. I suppose there's probably a way of changing the color of this thing, but I certainly don't know how. So here's our spotlight. We're up in this group here. This is our futures returns, and I've taken out the two biggest margins. I've taken out DAX from these results, and I've taken out silver from these results. Now, DAX is very, very highly correlated with the US equity market, so taking DAX out is no great biggie, because you've still got the S&P here, and you've also got the Russell. We've got two equity markets in here already, and silver is very highly correlated with gold. They're so highly correlated, in fact, that we trade them as alternates. You get a TO3 signal or a blue line signal in silver, you can execute it in gold, and so on. So having taken those two out, which are the biggest margins, doesn't really fundamentally affect what's happening, but it does bring the margin down to something that's more realistic for some of you, and this is only step one. And by taking those two markets out, we've reduced our total margin requirement to 31,000, whereas you'll recall before, if I can, that's not what I wanted to do. Excuse me while I get my tool back and get us back on track here. This is, we were down to a bit lower than this, were we not? Here we are. There we are now. Okay, we're back on track. So we've taken out, for this purpose here, playing with these numbers, we've taken out the two biggies in terms of margin. We've taken out the silver, and we've taken out with 11,000 odd margin, and we've taken out DAX with a 25,000 margin. So we've got that margin down now to total margin requirements to trade all of these remaining markets in here at 31,000. And what I've done is here I'm using 1.5 times initial margins. I was saying earlier I have these discussions every 6 months with Jerry about the size of margins. Now, understand about margins, but with this sort of trading, FractZen trading, your risk is limited by your stop plus whatever slippage you get on your stop. And realistically, you should only be looking at having the minimum amount in your account that you really do need to trade, and that, of course, you have to put up margin, so you need that. And so I've recalculated these figures, taking out the two biggest markets in terms of margin, and I've said that a reasonable size for the account is 1.5 times initial margin. And I think that's absolutely plenty. So we've been able to reduce the size of the required account to trade this group of futures at 40,000, and you'll see that it hasn't suffered much because your return is now 67% for 3 months, which is 22 and a bit percent a month. And if those figures are to continue through the year, you're projecting an annualized return of about 268% per annum. Down here, I've gone one step further and said, okay, let's do this sort of sensible thing and take out the systemic losers at this stage. This can be quite wrong because contrarian logic, to which I subscribe, says that if you want to pick which markets you're going to trade, you should pick the markets that have been performing worst, because markets are mean reverting, and they will then be the markets that are performing best. So that's a bit of a caveat for you to bear in mind, but having given you that caveat, let's just move on to this bottom panel where I've taken out the losers. I've taken out S&P, I've taken out DX, and I've taken out T-bonds. So you're left with oil, gold, copper, soybeans, sugar, and the Russell. You have a couple of metals in there, you have oil in there, you've still got the Russell in there. So we've pruned this down now to the stage of saying 1, 2, 3, 4, 5, 6 years, a potential model with 6 markets in it. And we haven't taken out the best and the worst necessarily. We've taken out the worst, but we've also taken out silver and DAX, which were very big contributors. But have a look at the numbers here. We've been able to bring this margin requirement down to 23,000, and that would mean 34,000 on 1.5 times margin. And you can continue to prune it this way. I'm trying to show you ways that you can put together your portfolio if you have constraints on the size of your available accounts, which most of us have for one reason or another. Have a look at that. You're now up to 28.5% per month for the first 3 months, and if those returns continue, you'll be talking about over 340% per annum, which are sort of numbers that not only have we never seen, but no one has ever seen. So it's a great opportunity, FractZen. I'm, continue to get more and more excited about it, and I'm not really a person who gets excited about this stuff. And what I then wanted to do was just show you the nuance of what's going on inside FractZen. So here's a daily chart of the best of the FractZen futures markets, which is sugar, and you can sort of see why. It's had a run down from January into February. It's had a big run up into March. It's had a pullback and then a rally. In other words, there's been quite a lot of momentum in this market on the daily charts during the period that we're talking about. So then I went and said, well, let's have a look at the worst one of them. Here's the worst performing futures market in FractZen, and this is the US dollar index. And strangely enough, it's got a similar sort of pattern. From January, it had a little peak, a big pull down, rally up in 5, 6, 7, 8 days, big run down all the way down to the contract rollover in mid-March, rally up, and it's been sideways the last 7 or 8 days. But there's as much daily volatility in that chart as there was in the previous one I showed you. So the secret to what's driving this thing is not the daily volatility. It works on a much more micro basis than that. But there was a sort of a sensible look at what drives this FractZen, about which I'm going to talk more now. I told you at the last webinar that we've arranged for any of you folks, whether you're already Daniel Code members or you're going to do a free trial with us or whatever, that Jerry Winter, who's our supporting broker for the Daniel Code, a good friend of mine. I've known him for many years. He's my personal broker. He's a very good bloke, completely honest. And I have arranged with him that he will give you a free one-on-one consultation for 1 hour. Jerry's done a couple of the Daniel Code tutorials. He really knows how the Daniel Code works. And not only for you new people, Marilyn, this is for you. and others who've joined us recently, but also for anyone else. Get hold of Jerry. There's his Skype, jerry.winter, and send him an email, jerry at fptrading.com, and set up an appointment with him, and he'll be happy to set you up for a one-on-one consultation. I don't think he uses GoToWebinar, but he's got a similar sort of program. He'll be able to take you through the charts, show you how to use the Daniel Code tools, and generally get the most out of your Daniel Code trading. Excuse me, here's our next slide, which you can now see. And the lovely Sage occasionally sends me something like this that she's particularly impressed with it. She knows it'll make me happy for the day. And there's nothing like a big winning trade, is there? Here's the DAX making $8,200 with a losing trade of 500 and 800 against the 8,000 it's made. So these are the sort of trades you can expect in FractZen. This is a multi-day trade. Here's another from Sage who last week described herself as the spreader of joy and abundance as she does these charts, and she certainly still got my vote as the spreader of joy and abundance. Here's USD Japanese yen, almost $1,500 in that FractZen trade. I just show you these so you can be aware of them, get used to them. We have more of them on our Facebook page, but we don't sort of post them all by any means. We just post a few when Terry gets a chance to do it. And here's another one that just came in this morning from Sage. This is trading up to yesterday, I think. British pound, Japanese yen, $2,900. Pretty nice stuff. Free trials, folks. We're running towards the end of our hour, and I know it's Friday night. Most of you want to go out to bars and drink, or sit out and have a drink at home. It's much better. We've got our dreadful driving rules here, which I actually support, having spent many years of my life driving drunk, and only by the miracle and hand of God that I'm still alive here. Some of the things we got up to as kids 50 years ago. But really, you're better off buying a bottle of something nice, or a couple of bottles, and have a friend around and drink in the comfort of your own home. But anyway, here we are. These are the free trials. You can have a free trial. We can organize that for you with Trade Navigator. And you can have a free trial of anything we do at the Daniel Code. I've put Terry's phone number in here, incidentally, folks. His phone number, he's actually lives in Canada. The area code is 1-260-918-0155. And please keep those calls to between 9 a.m. and 5 p.m. U.S. Eastern Time. But anything you want a trial, you want to talk about this stuff, please call Terry. If you want to talk trading, get some more clarity on how to make all of this marvelous Daniel Code stuff work, call Jerry, Jerry Winter, and set up a consultation with him, and you'll be well on your way. Here's what compliance requires me to tell you, which is that there is a high degree of risk in trading. There are all sorts of risks. Those of us who've lived through the PFG debacle know that there's a couple of biggies that we're not even required to tell you about. But be assured that trading, whenever there's an opportunity to make money, there's an opportunity to lose it. So make sure you understand your trading and your stop-loss protocols and who you're trading with. And we've got people who will give you great advice. Make sure you discuss all of that in detail with Jerry before you start trading if you're new to this game. That's pretty much what I have for you, folks. I'm sort of getting truly excited about these FractZen numbers. They're standing up. They're absolutely huge. And I want to, give you some thoughts today about. Let's let you see the full screen here. I wanted to give you some thoughts today about how you can get these account sizes down, because for most of you, where's the one where I took some of these markets away. Here we are. For most of you, these account sizes might be too big. A lot of you, they are far too big. So, you know, if you've got to pick and choose from a number of markets, have the absolute most you can, because I've been able to show to you that if you're just, you know, picking the markets you like. Everyone picks gold. Look, it's not a particularly good market. It's not bad, but it's not one of the high flyers. Everyone else there, everyone picks gold in the S&P. The S&P is close to our worst market on FractZen. So, you know, if you're on that, switch over to the Russell, for goodness sakes. And use these figures that Darryl and Sage go to so much trouble to put together. Use them to make some intelligent decisions about how you can get into this FractZen trading. For those of you who haven't already seen it, I do urge you to ask Terry to give you a trial. It couldn't be simpler. You get a text sent direct to your cell phone. It's close to real time. Matter of seconds, even in Australia, which is, you know, about as far away from New York as you can get, where the signals are, where we generate them. Straight to your cell phone, it just says buy gold or sell S&P, whatever. Just execute that trade. We tell you what the stop loss is that we suggest. You can use less if you want to. I talked last tutorial about using that as a fixed stop loss. Just convert that into dollars and make that a fixed stop loss. And make sure you put the stop loss on GTC, which stands for good till cancelled. Some of these trades go for days and days and days, and normal protocols is your stop will lapse at the end of that trading day unless you declare it to be a good till cancelled stop. So make sure you do that, and have a look at these figures. See what you can manage within your account size. But I don't know. I'm pretty close to saying this might be the best thing I've ever invented. It's you know, it's getting up there with GMAG and returns. It's starting to challenge all that stuff, which is complicated, hard to do. This is just simple to do because you don't have to do anything. If you've got a cell phone and you can read, you can get all these signals. They come direct from our own servers, and you execute the trade, and we've got the result of the last 900-odd trades here that we're showing you. So this is certainly something you should be getting into. And the sooner the better. So I commend that to you. Let me see, we've now reached the 60-minute period, and I'm now going to switch over to taking questions from you, but folks, don't go away. But that's the end of the formal part